I'm Ben Reppond. Today is May 22nd, 2024. Welcome to my YouTube broadcast. The piece I want to cover up front is a paradox. The paradox is the stock market continues to go up and up. Yet the economy or parts of the economy are struggling. Some parts are actually going down. So depending on the industry that you're in or you follow, and depending on where you live, you may say, from what I see, it makes no sense that the stock market is going up. And I agree with you. So the consumer is getting squeezed. They are getting squeezed because the market looks like it's going up. There's money being made. They are borrowing money, having to borrow money to live, to pay their bills, to get food on the table, and their income is not keeping up with the cost of goods and services. So, a paradox. So, what can you do? What can you do about it? I don't know what to tell you, other than if you have the opportunity to increase your income, a side gig, work overtime, etc. I don't know what else to tell you, but that's the reality of what's happening right now, and there doesn't appear to be any relief in sight. Okay, now we'll go to the dashboards, and the first one is the major indexes. So I have here, going from top to bottom, the 6 equity indexes, the 4 that are the U.S., the Dow, the S&P 500, NASDAQ 100, and the Russell 2000, and the developed markets, foreign markets, and the emerging foreign markets. Followed at the very bottom by the TLT, which is the ETF for the long-term government bond. In the yellow box are the results for this last week. All 7, including the 6 equity indexes and the long-term government bonds, all 7 are positive. That's good news. To the right of that is the pink box, which is the year-to-date numbers, and that's the way I rank them based on year-to-date. At the top is the S&P 500, and then the NASDAQ 100, and then they go on down from there. Of course, the bonds have been terrible this year, so they are still negative by about 7%, putting a pretty big drag on 60-40 buy and hold portfolios. When you go to the right of that pink box, you can see how these indexes are relative to their moving averages. From left to right, the 20, the 50, 100, and 200-day moving averages. All 6 equity indexes are above their 20-day moving average, or their 20, 50, 100, and 200-day moving averages. Very positive, very bullish actually. And even the long-term government bond has now moved above the 20 and the 50, still below the 100 and the 200. So generally a positive report. 26 out of the 28 are positive compared to last week where there were 25 out of 28. Also, as of last Friday, May 17th, look at the sectors inside of the S&P 500. Very hard to get all of these above all 4 of those moving averages, but it did pretty well. So only one sector in the yellow box, only one sector was slightly negative. Everything else was positive. Year to date, 8 out of 11 are positive. Very hard to get all 11 positive. So this is probably about as good as we're going to see. I mean, I don't recall seeing one in the last couple of years much more positive than this. The bottom one is the telecommunications sector. It is below its 100 and 200-day moving average, but is above the 20 and 50. All others are above all four moving averages. A very positive sector report. Okay, moving on to the charts. So this is the S&P 500 represented by SPY, the ETF SPY. And you can see going from October of last year to May of this year. So this is about 18, 19 months, probably about 19 months of data represented by the black arrow. So it's 24 months total, but it was gone up for about, generally, for the last 19 months. Going from the bottom, the bottom of that arrow to the top of that arrow. Again, several weeks, the last several weeks, positive, 2 or 3 weeks. I put this into, from a 24-month, I compress it down to a 9-month chart and move it over to candlesticks. So it gives you a little different view just in the short run, and this gives you about a 7-month view on the black arrow. The black arrow has been going up. Of course, it's been going up for, as I said, 19 months, but I took the shorter period of time of 7 months to show really what's been going on. If you don't know candlesticks, the blank candlesticks with just a box without any color in it represents that in that week the market started here and ended here, started here and ended here, etc. When the reverse is true and it starts here and goes here, then that's colored by red. So you can see in the month of April, April was a negative month, you can see in the month of April kind of how that went down. But since April, the end of April, beginning I think on the first day of May, it's gone up. When I contrast, do a relative strength chart on growth versus value, SPY-G versus SPY-V, it shows that when it goes up, it favors growth, SPY-G. When it goes down, it favors value, SPY-V. You can see about 3/4 of the way through where it went down consistently for the months of October, November, and December, pretty much straight down. The market was going up in November and December. It went down in October, but going up, but it went up with value. So value was in favor regardless of what the market did during that 3-month period. Since that time, it's gone up and then back and forth. So generally speaking, over the last year and a half, it's been going in a direction that favors growth. The S&P 500 is the largest 500 companies in the stock market, and when I contrast that on relative strength with small cap, represented by IWM, it favors large cap. So SPY, large cap, has been in favor. This goes back to, it's about 14 months that the market has gone up, large cap has gone up relative to small cap, represented by the black arrow. Bonds have gone up for the last couple of weeks, 2 or 3 weeks. You can see that at the very far right corner of the chart where it is ticked up a little bit, but the longer term direction, this is a 4.5-year chart, the longer term direction is that bonds or bond funds or bond ETFs are going down because interest rates and bond yields are going up. So this is a macro period. Micro periods on bonds or equities don't sometimes mean a lot, but I would say this is trouble for traditional portfolios, and it's trouble for those who hold some portion of bonds. And by the way, if you're in a target date fund in a 401k plan or 403b plan, you have probably a pretty high allocation to bonds depending on your age. But the older you get, the more allocation you get to bonds. They just do it for you. And if you look at your target date fund in your 401k, 403b plan, you may say, well, why isn't this thing going up? Or the market's going quite a bit up. Why am I not going up at all, or maybe even going down? This is why, because you have an allocation to bonds, and this is just one type of bond, but it's an indication of what is going on in general with bonds and interest rates. U.S. dollar continues to go up. It, went down last week, but a little bit. But generally speaking, you can look back over this 3.5-year period of time, or say 3-year period of time, represented by the black arrow. The dollar is strong. It's strong against other currencies. You may think that the dollar is weak because it is not backed by gold, or it's just paper out there with nothing behind it. I agree with you, but that's not how the dollar's valued, because we're the reserve currency. We're valued against other currencies. So relative to other currencies, this is what the dollar looks like. So when you can travel, or you can buy goods and services from other countries, and you're spending your U.S. dollars in other countries, okay, it's going a long ways. This is why. The dollar relative to those currencies is strong. Gold had a very good week, and as I record this, it's having the beginning of another good week. Will it continue? I don't know, but it is on a tear. The best assets out there right now are precious metals, and gold is kind of a cornerstone of that. So yeah, very, very strong week for gold. I'll give you more data later. This is a 24-month weekly chart. Silver is going to the moon. I mean, this is crazy. I'll give you the numbers, but boy alive, look at those last 2 weeks at the far right of the chart. Amazing. Silver, which had struggled for a good portion of a year, kind of went nowhere, all of a sudden has taken off. Silver, relative to gold, is doing strong. They're both going up. But to the far right of the chart, look how much more silver is going up than gold. In my equation, silver is the numerator, gold denominator. It is doing very, very well relative to gold. I remember reading things over the weekend based on Friday's close and the week's close, which was like this, that don't be too overconfident that silver and gold might pull back now. So far, not the case. They're continuing to roll on up. So hitting some pretty high numbers. And I'll get into it later, as I said. So, but of the big winners, the biggest winner out there, maybe other than a couple of AI stocks, but the biggest winner out there is silver. Bitcoin had a good week. It's positive, and you see that, the tick up at the end, and from November of 2022, again, generally positive. Volatility index. Now, this is interesting because as equities go up, we've seen this, the market, people are relaxed about their positions. Like, I'm invested, I'm making money. So the volatility index, which is usually the inverse of equities, is dropping through the floor. So now it's below 12. This is a pretty low number. I think if you go all the way back to the early 1990s, you would see this barely dipping below short term, dropping below 10. And I think that's the lowest it's ever been. So we are getting to very, very low territory here at slightly below 12. No surprise, the Asbury 6 indicators, all 6 are positive. Their cross-asset relative performance comparing one asset to another as of Friday is as follows. Those that are positive for the last week, the last month, the last quarter. Stocks, more favorable than bonds. Low volatility, which is usually tends to be more defensive assets or equities, more favorable than high volatility or high beta assets. Large cap, shown this previously, more favorable than small cap. Technology, more favorable than the broad market, the S&P. Growth, more favorable than value. Emerging markets, more favorable than the U.S. And corporate bonds, more favorable than government bonds. The U.S. versus the world. Those that for the last week, month, and quarter are better than the U.S. are as follows: Chile, Switzerland, Italy, Spain, Malaysia, Hong Kong, Singapore, Taiwan, China, and Australia. The ones where the U.S. is stronger are Brazil, Japan, Taiwan, India, and the Pacific. So, interesting mixture that covers, some in Europe and Asia and South America. A pretty broad mixture. This is U.S. versus Switzerland. The black arrow represents the degree to which the U.S., represented by SPY, has outperformed Switzerland, represented by the ETF EWL. Okay, now we're going to get into some detail on the precious metals. You saw that gold has gone up a lot, represented by GLD. The physical gold is $2,416 per ounce of gold bullion. Now, if you get the Gold Eagle, you will pay up for that. And, of course, you have to pay the premium, the commission on top of this. So this is up 2.4% from this past Friday compared to the previous Friday, May 17 compared to May 10th. Silver, as I showed you earlier, is up a lot. $31.47 for spot. That's an 11.8% from the previous week. Not the previous month or the previous year, the previous week. Wow, that's a lot. And that brings the gold-silver ratio down to 77-1. A monster box, of course, is going up in price. The price for a box of silver bullion is $16,335 because of this big increase in spot. What's interesting to me is that the markup on spot, on these coins, or this bullion, generic silver, is $1.20 unchanged. The price went crazy high, but what really, in my opinion, really represents supply and demand is the markup, unchanged, $1.20. So that takes that price to $32.67 per ounce when you buy it in a quantity of 500 rounds, which is a monster box. If you drop down to a tube, one tube, it's 50 cents more per round, or $33.17. So it has gone up a lot, and still at this point seems to be on the move. Almost 3 years ago, I think it was August of 2021, remember, if you follow it, the markup on generic silver, here it is, $1.20. The markup was about $5 a round. when you bought the Silver Eagle, it was about $10 around. And there were people who wanted to buy, and they just said, I'm not going to buy it at these ridiculous prices. Well, they were correct, because not only did the spot price come way down, came down into the 20s, actually, into the low 20s, but the markup came down. And in the past several months, it has come all the way down to slightly over $1 an ounce, $1.20, indicating that, according to my son, Preston, he says, Dad, the reason for this is people don't have any money. Well, some people do, but the average person does not have the money they had 3 years ago, when some were willing to pay $5 a round. Not anymore. It's representing the fact that the demand is not as strong because of the lack of discretionary funds by the consumer. As the market goes up, I have conversations with people, and sometimes they think, this is the top, this is the top. We don't know. It could go up a lot from here. Mike Wilson thinks it's going to go on up. Others, many others, think the market could it correct a little bit? Yeah, it could. But it, generally speaking, seems to be, at this point, on an upward trajectory. And regardless of how bad the economy is, or struggling the economy is, or consumer credit, or the government debt, whatever, the market itself seems to have some legs and is moving up. And so if you want to guess where the top is, good luck on it. There's plenty of people who are wrong on that issue, but I understand it when people want to take money off the table or want to diminish their risk. I understand that. So thank you for watching. If you have questions or comments, leave them in the comment section below.